Finally, risk reward. That's kind of, we kind of pull it all together. We generally, our team here that I manage, I didn't mention kind of my team, but we manage about $1.5 billion in assets under management. There are a couple different strategies, a relative value strategy and a deep value strategy. And we look for a 3-to-1 ratio of upside to downside before we invest. So for every unit of risk we undertake, we want to be compensated for 3 units of return. That's our threshold. And we look out 3 to 5 years over an entire investment in the business cycle when looking at our valuation. And finally, the search for value. Why do I say value investing is easy to say and hard to do? It's not hard because it's inherently hard. It's really not that difficult. You don't have to have a 160 IQ to do this. What you really need is the right temperament and the patience to stick to your strategy, your discipline, and not be influenced by all the factors that are out there floating around. And I think most people are not hardwired to buy stocks as they're falling and sell stocks as they're rising, which is what we do. And so, unlike growth companies, for example, with exciting and familiar stories and positive stock price movements, most value stocks have a stigma. Something's going wrong, and something's gone against the company, and the stock's under pressure. Our job is really like kind of insurance underwriters. We're underwriting risk. We're taking a look at the problem and the risk that's occurred and determining whether it's permanent in nature or temporary. If it's permanent, we're not so interested. If it's temporary, we're pretty interested. We want to find out what the nature of that risk is, the exposure, how long it's going to last, and then what the company looks like coming out on the other side. And so therein lies the difficulty, I think, in value investing. Going against the crowd, having conviction in your thesis during uncertain times, and then doing the fundamental work and research to support it. And in the end, we always remind ourselves, a good company does not mean it's going to be a good investment, nor does a bad company mean it's going to be a bad investment. It determines whether your investment's going to work or not, the price you pay. We're extremely price conscious, so I think that's the most important thing to do at the end of the day. I talked a little bit about intrinsic value, and I want to tell you a little bit how we go about defining it. Many people define it differently. I think this is pretty similar to most people who do value investing, but there are variations of this. Like I said, amid all the cross-currents, this keeps us anchored. What is it worth? That's what we ask ourselves constantly. We define intrinsic value 4 different ways: going concern, net asset value, free cash flow, and private market value. Now, the first concept is going concern. This is really what you might call an income statement approach. So this is where we look at a steady state business under normalized business conditions, assuming no structural changes to the business. And then we look at the normalized earning power of a company and return on capital potential over a 5-year period. So essentially, this is kind of like a reversion to mean concept, asking ourselves where's the company today in the business cycle, and what is it going to look like 5 years out? And are they over-earning today? Are they under-earning? And then what is it going to look like when it reverts back to their normal level? And then asking ourselves, what will the market pay for these underlying business characteristics and performance? So that's going concern, an income statement approach. The second approach is called net asset value. This really is a balance sheet approach. This is where we look under the hood and do an appraisal value of the assets, both the quantity and the quality of those assets, and then look at the resources and evaluate the long-term wealth creation potential by unlocking latent value. We're often seeking out hidden assets here the market is overlooked or failed to recognize. And the assumption here really is companies are constantly employing and redeploying assets. They really never stay the same. They're doing all sorts of transactions. They're doing refinancings, they're changing the capital structure, they're doing M&A, an LBO, a spin-off, an equity tracker, using net operating losses, maybe a sale leaseback transaction. There's all sorts of things companies can do to drive value. What to do is do an appraisal, take an inventory, and buy assets at 50, 60, 70 cents on the dollar by taking an inventory of those assets. And then handicapping the optionality for change, so to reposition those assets and their capital structure for the highest and best use. Third concept is free cash flow. You probably hear a lot about that. This is really what you might call owner's earnings. This is cash-on-cash returns. And we generally like to see a company with an 8 to 10% free cash flow yield, growing over time, and usually about 300 basis points over the 5-year treasury compensates for risk. And we're often looking at the optionality of this free cash flow. What can they do with it? Can they pay down debt to drive home shareholder value? Can they use it to pay a dividend to drive shareholder value? Can they buy back their stock if it's cheap to drive shareholder value? We want to know what the optionality is involved and what can they do to drive that share price higher over time. Fourth is private market value. This is really a takeout value of the company. Asking yourself what it's worth to an outside investor in an arm's length transaction. And we look at it both from a strategic standpoint, assuming synergies, as well as from an LBO standpoint to a financial sponsor. So taking together these four methods kind of converge on a range of value that we can get comfortable with. And we obviously then, again, converge on a number. It's not an exact number, it's kind of a range. We compare it to what the stock's trading at, and if the gap is wide between price and value, we're excited. So we'll be interested in the company. I'll talk a little bit about efficient markets. I'm sure you hear a lot about that and have learned a lot about efficient market theory. Say the markets don't work, they do work. But they're also inefficient, and not from a broad stroke standpoint, but there are pockets of inefficiency that occur. And we value investors look for these kinds of mispricings. This is the fertile ground that we look at. And so people often ask, why does this happen? Why do mispriced stocks occur? And why do you say value investing never goes out of season? Well, these pockets of inefficiency occur for many reasons. And I've given you here a list of reasons where value can detach from price. And a lot of it has to do with imbalances in the market or illiquidity. But there's many groups, and so many factors can contribute to this. And some are related to style, some are psychological, some are technical in nature, and some are just related to the composition of market participants out there, perhaps the lack of diversity in stock ownership. So for you, I have here a list of categories where I consider right market inefficiencies can occur. And value investors, frankly, search for opportunity. It has to do with companies undergoing change, uncertainty or clouds over an industry or a company, secular issues, cyclical issues, perhaps rebalancing, window dressing, a dividend's been cut, panic selling. There's all sorts of reasons that prices can detach from value. Here's kind of a listing and where we search for value. I'm going to skip over our approach. I think I've touched a little bit on it. I know I'm short for time. This is our investment process. Suffice to say, we screen for, first step is here, we screen for cheapness in the market. We look at all sorts of metrics to find cheapness. Your traditional price to earnings, price to book, price to cash flows, enterprise value sales. The second step is we subject ourselves to risk-reward criteria, looking for that 3-to-1 ratio of upside to downside I talked about. That manifests for us in a 12% expected return over a 5-year holding period at a minimum, 30% downside price risk, and a 40% discount to private market value. Stage 3 is what I really wanted to talk about. That's where we spend the vast majority of our time. That's just doing due diligence. That's where we look at industries, look at companies, look at positioning. We look at margins, we look at past cycles, we look at this cycle, we think about future cycles, and then we determine intrinsic value and decide, based on our due diligence, is it the right time to invest? And finally, we throw together a portfolio, generally 40 to 60 stocks. This is our team, 5-person team in Los Angeles that I manage, and it's a great group, great chemistry, and everybody adds tremendous value, and I'm thankful to have such a great team working with me. So that's it in the summary. I wanted to shift, I know I'm limited for time, 10 minutes here, but I wanted to kind of tell you where we're positioned today and how we look at the world. These are our current investment themes today and how we structure our portfolios to try to capitalize on what we see out there. And what I want to hit on today is the 6 themes I've identified. The market's interesting. We had, obviously, the downturn. We had a market rally subsequent to the downturn. The PE multiple on the market ran from about 10 times to 13 and change, up 30%, which is traditionally what it does in a recovery, when the market prices in a recovery. And the high beta, high cyclical companies, or companies that were priced for bankruptcy, rallied the hardest. So the easy money's been made there. We're now transitioning to, I think, is from recovery to expansion, where it's really a stock picker's market. We think that really is our sweet spot. And so this is some of the stocks we own under some of these themes, and I'll highlight a few for you. We think it's a unique time right now. The blue chips on sale right now, blue chip companies.